sales and delivery consultant here at Make My Property, and I'll be your host for today's exclusive webinar. Thank you for joining us today. Before we begin, a quick legal note. The information shared in today's webinar is general advice only and does not account for individual circumstances. Please consult an independent financial professional before making any investment decisions, and keep in mind that present results do not guarantee future outcomes. With that, today's session will be covering a very timely topic, something a lot of you have been waiting for, which is why a cooling market in 2026 is good news for buyers. So looking at how smart investors can use market timing, deal sourcing, negotiation edges, and also value-added strategies to build wealth right now instead of waiting. So leading this session are two experts, Vikas Jindal, founder of Make My Property, and Rakesh Garg, co-founder. Together, they bring over 20 years of combined experience and have facilitated more than 70 million in transactions and specialize in commercial and residential properties across Australia. So you guys are in good hands. With that, I'll now hand over to Rakesh to take it from here. And over to you, Rakesh.
Good evening, everyone. First of all, thanks for coming in the evening and joining our webinar. So, as mentioned, the topic for today is why a cooling market in 2026 is a good news for buyer. As we were discussing before the formal start of this webinar, that a lot of investors are confused with a lot of things happening in the background in terms of the interest rates are rising. There is a global things around everyone, increasing the petrol prices, commodity prices, a lot of things happening in the Middle East. So the purpose of this webinar is to understand that what is important in this time, why you should, as a savvy investor, use this opportunity to invest instead of waiting and losing the opportunity. So if we talk about any investment strategy in general, there are few things which always considered what is the good investment strategy. The first and foremost thing is the market timing. So we should consider what is the best market timing to invest in the market. And if you see the right now, with a lot of global meltdown, people are scared of the market. The market timing is the best because there is a heap of stock coming in the market, but a lot of investors are not investing and they are waiting for the right time. And those who are coming to the market, they are getting the bargain prices on the investments, and those gonna be give them really good capital growth in the future. So deal sourcing is finding and evaluating the potential opportunity, which is again, you can do it yourself being expert if you know. If you don't know, you can hire any experts for finding the right deal. Negotiation edge, as you know, whenever there is supply is more than demand, there is always a negotiation edge possible in the market. And value add strategy, you can find a lot of properties in today's market where you can do value addition. You all know value addition in terms of buying a big land and then adding granny flat later, or reno and flip, buying something, do some renovations, and either hold it or flip that property and get some instant money. So a lot of, especially when the demand is less, all type of opportunities in the market are easy to get, and you get it at below market price. Now, as Varun has started, we discussing about the Australian budget. So all of you being investors, you must have read a lot of articles, listening to the experts, what is the budget, how it's going to impact the investors, starting from day it was announced on 12th of May, starting from 1st of July 2027, starting from 1st of July 2028. There are different timelines from where different type of things are starting as per the budget. So first of all, capital gain tax, as you already know. See, I'm not an expert in this matter. I'm trying to give my whatsoever my understanding of the budget is. I'm trying to discuss here. So please check with your sources. Please double check and don't rely only on what I'm talking here. So as per my understanding, right now the capital gain tax is you get 50% discount on any asset you held for more than 12 months, irrespective of it's a commercial property, residential property, it's your shares, any type of asset. In there is a capital gain, you pay 50% capital gain tax. If, for example, you get 400,000 of capital gain, there is no tax for 200,000. For remaining 200,000, you will pay tax, And how much you pay, that depends on if you're 200,000, your gain is under your trust, you pay according to your trust tax rate. If it's under your personal name, you pay according to your personal tax slab. So that depends on your which slab or which entity you got that capital gain. So from 1st of July 2027, they have replaced it with inflation-based model. Inflation-based means instead of everyone coming into the same umbrella of 50%, depending upon how the inflation is going, accordingly, you will get the benefit of the capital gain tax, capital gain discount. So it's not one solution fits everyone. So sometimes, as with this formula, if your capital gain is less and another person's capital gain is more, maybe you will get benefit. You will get even more than 50% capital gain discount. It depends on the situation to situation. So the investors will only tax on the real gains. So after inflation. So if you want, I can give an example. For example, you bought a property as per 1st of July 2027, as per the valuation that will be given by the ATO. There must be a tool. Your property value was 500,000, and you sold that property after 3 years. So the value was 800,000. So, and we are considering there is a 3% inflation for those 3 years. So considering 3%, your 500,000 property, the 3%, if you go by the inflation on 500,000, and then another 3%, another 3%. So they will calculate the total value of that property after 3 years based on the inflation, and then they deduct the total capital and give you the tax based on the remaining amount. So it applies from 1st of July 2027. So it's not applying from today, it's not applying from this year, it's applying from next year, which is 1st of July 2027. So what are the it's this particular changes are only applicable for the properties which are already built, which are the old properties. If you are buying any new property, then this original arrangement is continuing. You will get same 50% capital gain tax discount. You will get the negative gearing, and you have choice that either you can go with 50% discount or you can go with indexation, whichever method is more beneficial for you. You can choose that method. So that's where the purpose of this particular difference is, that the government wants people to buy more and more new houses, so that there is a shortage of the houses. As you know, the migration is going at a higher pace than the construction industry. So when the government will give discount on the new properties and the negative gearing is only allowed on the new properties, so the investors has a motivation to buy more and more new properties, which will give the construction industry edge, and lot of people gonna buy the new properties that will add up the new houses to the market. Now, talking about the negative gearing, as I was already mentioning, it's banned for the established properties. If you buy any property from after 12th of May night 8 o'clock, if your contract is signed after 12th of May, you can do the negative gearing until 30th of June 2027. But after 30th of June 2027, you can't do the negative gearing. Negative gearing doesn't mean that any losses you're getting on your residential property, you can't, that will be zero. It will be keep on adding up. You can use that when you sell the property against your capital gain, or if your property becomes positively geared in the coming years, then you don't have to pay tax. Instead, the losses that you have carried forwarded for the negative cash flow, that will be offsetting. But you can't offset it against your other income, which is done by most of the professionals today. Those who are in the high income bracket, they are using the negative gearing to offset the tax, save their personal tax they are getting either from their business, from their job, so which will be not available from 1st of July 2027 for the existing properties. For the new properties, if you're buying, that's possible, and it's not grandfather. Means any properties you are holding before 12th of May, anything you have bought before 12th of May, it's still eligible for all the previous negative gearing, capital gain tax benefits. It's only for the properties bought after 12th of May. So, and from the trust and tax, there is a minimum 30%. They have added the trust tax because a lot of people were using trust to save the tax. The trust is not meant to be as a tax vehicle. Trust was meant to be your asset proportion. There are so many other things which your accountant can explain you in a much better way. But to make it as per the government, as per the treasurer, to make it as a level playing field, they have increased the tax on the trust, so that people who are buying in their personal name or they are doing personal tax, they should be at the same level field. So moving forward, now what is the impact on the housing market? Again, you guys are here, as I mentioned before as well, that now a lot of people are shifting the focus to the new development. Even myself, since I have heard this budget, I have bought 3 blocks in South Australia because I'm speculating that in the coming 12 months to 24 months, there will be a lot of demand for the new housing, and people gonna buy a lot of new houses. And if you having one to sell, you will get a good capital growth or good value for your new house. So again, it's depending. And today only I was reading a news which we have shared in this uh, webinar as well, that a lot of people are shifting to the commercial market as well, because commercial market is totally not dependent on the new rules that has been changed this year in budget. So the commercial market, we have like people who are buying commercial property, they are positively geared, so there is no risk of negative. So those things we will be discussing later in the webinar. So again, a lot of new changes coming. People are thinking about their new strategies, whether they should sell their properties or whether the new properties they want to buy in this year or coming years, whether they should buy the existing properties or they should concentrate on the properties which are newly constructed, or they should invest in the other assets. So a lot of things, discussions going on everywhere. Now, let's come to the point that we were discussing about why the cooling market is an opportunity for the investors. So I will take an example of few events that happened in the past, which are major events where everyone was thinking that the market will crash. I'm talking about on the perspective of the Australian market. I'm not talking about the US market or any other market, because we are in Australia and we should concentrate on the Australian market. So whenever any big negative event has happened in the past, what has really happened and what happened after the event. So during COVID, if you everyone predicted that because of COVID, every all the businesses are getting closed. There is big economic downturn has happened, that housing market will crash. So the experts were predicting at least 10 to 20% crash during the COVID, and it can go up to 30 to 35%. What happened actually in the COVID, the decline was only around 2% maximum, and then the market surged from 25 to 35% within less than 2 years. And some of you who are attending this webinar, you must have bought the properties during this COVID period, and you know that your properties get doubled in 3, 4, or 5 years. And that's the best time. Those who have bought the properties in Queensland, in Western Australia, or in South Australia, their properties have got really good capital growth. So what is the reality? Reality is the cooling market is always a better entry point because there is less competition and you get strong negotiation power. Now, talking about the 3 other examples, the COVID is the one recent example that we can discuss. So we have GFC, which happened from 2008 to 2012. Then there is a Australian credit squeeze where the Australian government comes with a new credit rules, which actually after that the people's borrowing power was reduced. They have implemented new rules. Then there was a rate hiking cycle that happened after the COVID. A lot of rate rises happened. So I will discuss one by one all of this. So let's talk about GFC, which happened from 2008 to 2012, and it was not actually in Australia. It started from US, where there was a big housing market crash. So it was a global fear, and that time RBA cut the rates from 7.2% to 3%. So almost 4% cash rate was cut, and the interest rate before GFC was around 9 to 10%, the house interest rate, the home loan interest rate. But during that time, to stimulate the market to have a positive fundamentals in the market, the RBA cut the rates heavily. Same thing they did it in COVID. There was a brief decline of 3 to 5% in many areas of Australia. So the Australian banks were strong, they were stable, they were running fine. This government added more positivity by giving the stimulus packages. First home buyer incentives were given, and I remember one of my friend who bought that property. Government was giving 35,000 first home buyer grant. So $35,000 was given as a cash to buy home, and at that time the property prices were not 1 million, 2 million. The median house prices were 400, 500,000. So 35,000 given by the government. You can see how much money they put it in the market to boost the housing market. So population growth was happening as usual. Lot of migration was happening. That's where the house demand has never gone down. So we have to differentiate between the Australian market and the other markets. Australian market is actually always strong. Reason is the migration, because whenever there is a demand coming, doesn't matter your interest rate is going up, doesn't matter there are global factors coming, but the housing demand can't go down because people need houses. If they stop the migration, that's where the problem can start. But as long as the migration is happening, the new people are coming from different countries, there is always going to be demand, and it can happen. That's happening right now. The market going to slow down for some time, but it's not going to happen continuously, or their market crash. There is very less chance that market will crash. So the market rebounded in 2009 2010, and those people who bought that property during this GFC global financial crisis session, they made a whole lot of capital growth. So I don't know how many of you were here at that time, because it was quite history, past history even. But if you talk about 2017 to 2019, I can relate it because I was here during that time, and I did the lot of investments, and I really get the lot of capital growth because of people who were scared that the loans are becoming harder. The RBA has added new rules for the credit check, and a lot of credit normalization has happened at that time. But again, things become normal, and automatically the market comes back. And there was a lot of capital growth that has happened even after the Australian credit squeeze that has happened in 2017 to 2019. So rate hiking cycle that's happening right now, we were at historical low during the COVID time in early 2022, around April, May. The first rate has been increased. At that time, our cash rate was 0.10, and then they started increasing from 0.10. They went to 0.35. Then they increased in the increments of zero point 0.5, zero point 0.5, zero point 0.5. And everyone at that time thought, because now the interest rates are rising and it's rising rapidly, again the market will go down, the crash will happen. And you know what happened at that time again, because after COVID, although the interest rates were increasing, although the RBA was heavily moving towards increasing the interest rate, but because during the COVID there was no migration happened, and the Australian businesses were struggling because there was no labor, no skilled labor. Even the small businesses were struggling to run. So the migration happened at the record high. Because of migration, again, the interest rate doesn't make any big impact on the market. Even with the higher interest rate, the market keep on growing. People make really good capital growth. Everything keep going even during that time. So these events actually, which have happened in the recent past, or maybe 10, 15 years ago, simply gives us indication that all these things happening in the Australia is always temporary. Fear always there. Things happens, but it never be permanent. So if you see how I summarize this, there is always a temporary corrections. The all past market setbacks were short-lived. It's never permanent. Recovery always follow the fear. Every cycle has been followed by strong rebound and renewed growth, and it has done in the past. And those who are savvy investors in the Australia from if around 15 to 20 years, they can easily relate this opportunity in downturns. The savvy investor is a one person, or the real investor is a person who makes money when the market is going down, who makes money when the market is going up. He knows how to make money. So that is the time right now to invest in the market, because you will get a bargain, you will get something below market price, and as the market shift will happen, and it's never gonna be at high interest rate, your property market, your properties that you're gonna purchase in this time gonna give you really good capital growth. So 2026 gonna repeat the pattern. Fear is converting into correction, recovery, boom is the historical rhythm of Australian market. So Australia has never gone through recession. That's the history of Australia. Their fundamentals are very strong. Their banking system is very strong. And whenever any global fear, any global event has happened, the Australian government is upfront. They bring, like, if you remember now, when this war started with Iran, before any country comes, our government reduce the petrol prices by taking their own tax out of it. They reduce the tax for the large vehicle road tax. They In Victoria there is a free public transport they introduced. So they take measures instantly before it hits the market. So it's not in today's market. They have done it in the past, and every time there is something happened globally, they have taken the control, and they put the money into the market. They put the money into the different industries to make sure that the economy is going. There is no big crash happens. Now, this was all theory that I have discussed in general. Let me now explain something to you with the help of an example. Some of you were thinking, let's wait for 1 year, 2 year before this interest rate comes to normal, and then I will start buying. I will keep holding my money or whatsoever opportunity you are having. I'm taking an example of, for example, your budget is 800,000. It's a typical purchase price for an investor, 700 to 800,000. If you're buying at 80% LVR, your loan will be 640,000. 160,000 will be your deposit plus soft expenses. So at 640,000, your interest only repayments will be $3,360. I'm talking about interest only at today's interest rate, which is 6.3. And I'm assuming four more rate rise will happen. Four is like, I'm not talking about one or two, I'm taking four more rate increases happens in the coming 1 year. After four rises, your new repayment will be 3,894. It's a real data. You can go to the any calculator and calculate on 30-year loan, considering 640 as your loan amount and 30-year loan with interest only. So if you see after four rate rises, you're gonna pay $534 per month extra because of another four rises. If you convert 534 for 1 year, it comes out to be $6,408 for 12 months. And I'm assuming it will continue for 3 years. I'm going into the worst pass. That this high interest rate of 7.3 will remain like this for 3 years, and you will be paying extra $19,224 because of these four rises. Now, if you're considering today's market and if you compare the market 1 year or 18 months back, the market has softened. The same property that was selling for 800, 890, or there was for the same property, there were 20 offers coming, 30 offers coming. Now, same property is getting sold at a bargain. Maybe 4 or 5 offers coming, and the selling agent has to chase the buyer. It was opposite few months back. The buyers are chasing selling agent. They were submitting offers unconditionally. They were going above the advertised price. But now you are getting bargain. I'm saying even if you get a bargain of $30,000 to $40,000 on the purchase price by paying $20,000 extra on interest repayments, you're gonna still save around $20,000 just on the bargain. And now the next thing is your opportunity loss. If you buy some property today and it grows at 6 to 7%, which is a nominal growth, I'm not going 10%, 12%, 15% growth. I'm going with very nominal 7% growth. And you pay buying a property of 800,000 at 7% growth. If you hold it for 3 years and you don't buy now and you wait for 3 years, you're gonna lose around 180K in your opportunity loss. So think about it. Although it looks big when you say, oh, interest rate is going up, my repayment will go up. But when you bring it to the numbers, when you actually check the numbers are not that scary. It's your emotions. You talk to 10 people, you talk to 10 investors, your family members, your friends, everyone say because of the high interest rate, the your repayments are increasing, it will increase more. But I have given you the calculation here. Even with four more interest rate rises in 3 years, you're gonna only lose $20,000. You're gonna get that much more than back in the bargain that you're gonna get in now. And with your opportunity loss, you're gonna lose around 180,000 in 3 years on a purchase price of 800,000 with 7% capital growth. So you can see this is something makes logic. Now talking about a people who are having four or more than four residential properties, what is the scenario for those people? Previous scenario is if you are a new investor, you're gonna start your investment journey, or if it's your first or second investment, so that scenario is easily applicable to you. But if you're already having four residential properties and you're thinking to buy the next one, what will be happening to your portfolio and how it will affect your portfolio? So same thing, I'm assuming that the average purchase price of your four properties that you're currently holding is 700,000. Considering at 80% LVR, your loan will be 560,000. In today's market, the interest rate is around 6.3%. And your monthly repayments, again, I'm talking about the interest only, $2,940. Your annual interest only repayments will be $35,280. So this is your interest repayments. Then talking about the soft expenses, actually the 700 example I have taken for one of my own property, considering what I'm paying in interest, what I'm paying in council rate, water rates, insurance, property management, maintenance and repairs. So maintenance and repair is an approximate amount. 1 year it can go to $500. Next year it can be $3,000. So just an average $1,500 per year. So it comes out to be around 8,800 per year, which is around $750 per month. For a property of 700,000, the interest repayments are two 2,940. On top of that, 750 is your soft expenses. So if I add these two values, your holding cost per month is $3,690 per month, including your mortgage plus your soft expenses, which comes out to be 44,000 for the year. And I'm getting the rent on my property as 2,500 per month. So it comes out to be 30,000 in rental amount for one full year. So after these outgoings plus taking away my income, I'm paying around $14,000 from my pocket for one property. So if I'm having four properties, so I'm paying approximately $57,000 from my pocket in a negative cash flow to hold these four property in today's scenario without, I'm talking about interest rate rise, interest rate at 6.3% per annum. I'm paying around $57,000. So far, I was actually claiming negative gearing on this. If anyone is planning to buy the property now after 12th of May, they can't even claim the negative gearing. So that money is totally going from pocket and you're not getting anything back from your other income sources. Now, 57,000 is a big amount. It's not something which is small and everyone can afford to pay from every year from their pocket and still can sustain the portfolio. So now, what is the solution for these type of people who are bleeding with the negative cash flow, who doesn't have capacity to add that much money from their pocket? So the solution gonna be discussed by Vikas. So I will hand over to Vikas to discuss the solution for this problem.
Good evening, investors. Thanks, Astha. Thanks, Rakesh. So as Rakesh has mentioned, so far, like he has mentioned few aspects in this webinar, like he has highlighted how the budget is going to impact the investors going forward. It can be residential investors, it can be any kind of investors in the market, and how he like the in today's scenario, considering the current interest rates, and if any investor has only the residential portfolio, so how they are bleeding with the negative cash flows, right? So basically we are working in the in the buyers agency model from the last more than 3 years time, as mentioned by Artha in our introduction session. So as Rakesh mentioned, like if you guys, like for example, if you guys have a property portfolio of 4 properties, 5 properties, which is common for any kind of investor in today's market, right? So the negative cash flow is around maybe $60,000 per annum. So how it can be offset, how the investors can produce the positive cash flow incomes, like if they want to offset the negative cash flows from the residential properties. So like we have seen this trend in the last 3 years, like the investors who have started diversification into the commercial property market, they are able to make some passive income, they are able to make some sort of the positive cash flow from their properties, right? So why we are saying how the why you should invest into the commercial property market, there are few reasons which has mentioned here. For example, the strong cash flows, right? So in commercial property market, we always talk about the higher rental returns. In residential, we talk about the rental returns, maybe 3%, 4%, sometimes 5%, and that is always the gross rental returns. All the outgoings are generally being paid by the tenants. However, in commercial properties, in majority of the cases, the outgoings are being paid by the tenants. By the landlords. So we always talk about the net rental return instead of the gross. And the rental return can start maybe from 5%, 6%, and even to 8% plus, depending on the location of the property, tenancy of the property, lease of the property. So there are other factors as well, which determines the rental income from the properties. Second is the lower volatility. Lower volatility means commercial properties values are less emotion driven and more fundamental based. For example, if there is any changes in the economy, if any rate cut is there, and if, for example, if the budget is there, right? Because the commercial property market works more on strategy, works more on the numbers, on the cash flows, on the rental returns, right? So minor changes in the market does not impact more on the commercial properties, because if a commercial property is generating a good rental return already, it has already got a good lease, good tenant, so it will attract a good value in the market. So it is not like the commercial property the price will decline, that drop overnightly or in the next few months time if there is a changes in the market. So it is less volatile as
Babu,
compared to the other real estate in the market.
Pani.
Long-term growth. In the commercial property market, basically, like the people always say, there is a no capital growth in the property. It is always a myth. We purchased heaps of properties in the last 3 to 5 years time where we have seen actual growth in the commercial properties, right? So we always say there is a in the short term you may not get real growth or the good growth in the properties, because sometimes in the residential properties people say they get the equity in the next 6 months time or 12 months time, but in commercial it takes time. But yes, the properties grows over the period of time, because the major factor in the for the rise or any capital growth in the commercial is the rent increase. The rent increase is part of the leases. For example, 3%
Yep.
increase is part of the lease. Every year your rent will be increased by 3%, 4%, or the consumer price index, whatever it is that. So as long as your rental is going to increase, your property value is going to increase, right? The tax advantage, claim depreciation and other expenses to improve your overall returns. Of course, depreciation is the another income which we can offset against the income. And in commercial properties, the depreciation is higher as compared to the residential, because the construction cost is high in commercial properties. We have purchased properties maybe around 30 years, 50 years old, but still we are getting 15,000, 20,000, 30,000 and depreciation amount on a purchase price of even below 700,000. So tax advantages are more here. Diversification, reduce risk by diversifying your portfolio beyond residential property. We always say, like, we never say don't invest into the residential property market, but we always say try to diversify your portfolio. If you are already sitting on 3 residential, 5 residential, try to diversify your portfolio by entering into the commercial property market. And I will explain with the real case study like how the positive income generated by one commercial property can offset your negative flows of 2 or 3 residential properties. I will explain this with the real example. So as I mentioned earlier, the longer lease terms in commercial, the lease terms are always longer, maybe 3 years to 10 years, 15 years to 20 years time even. It all depends on the type of the property. Can you please go back to the previous slide? Yeah, I was discussing the lower section, the longer lease terms. So 3 to 10 years time or more. So the lease depends on the type of the asset as well. For example, for the childcare centers, for the fuel stations, for the medical centers, the lease is always the longer terms, 10 years, 20 years, 30 years. But in commercial, the thing is basically the stronger, the safe the asset is, the safe the lease is, the rental return will be less. So it is always the investor need to prioritize what they want to achieve in this industry. For example, if they want to say, if they are saying, I want to stay into the metro area, I want to invest into the childcare centers, like with the longer leases, then we cannot expect we can get 8% or 9% rental returns. If we want to achieve this kind of rental return, then of course we may need to go to the regional areas. Like for example, we have invested heavily in Rockhampton market, in Innisfail market in Queensland, and in W we have invested heavily in Griffith area. So
In Port Lincoln, a lot of properties in Port Lincoln.
in South Australia we have like
Port
in every state we
Augusta.
have purchased, and the real data, like whatever we have purchased, it is available on our website. And regarding the quality tenants, so basically in the commercial properties, as we always know, like if the tenant is good, if the lease is good, then it attract more value, right? For example, if there is a government tenant or if there is a national tenant in the property, right? So it attracts more value to the property. And as and when the tenant renews their lease, so there is a chances to increase the rent every year. Like as I mentioned earlier, like every year your rent is going to increase. And during the, for example, if there is a lease of 5 years and after 5 years there is a market review, during the market review you can increase the rent maybe by 10, 15, 20%, depending on the type of the tenant there, depending on the what kind of business is there. And once the rent is increased after the market review, your property value will be increased. So the tenants also plays a major role, and the stronger yields. As I mentioned earlier, the yields in the commercial property market is higher as compared to the resi, which I already spoke. Like maybe we have achieved properties maybe more than 12% rental return, but those properties are very uncommon, to be honest, and they are generally in the very remote areas. But it is always the preference of the investor, like what is their priority, because sometimes the priority of the investor is to buy the properties which generate huge cash flows. Like they are not bothered, or they are very risk taker guys, investor, right? Sometimes the investor says, I want to stay into the metro areas, but they are comfortable buying properties maybe 5 to 6%. So it depends on the investor appetite. Capital growth. Capital growth driven by limited supply and high demand. So the capital growth, as I mentioned, like there are few factors which helps to determine the capital growth into the commercial property market. Like for example, whatever factors are there for the residential property, infrastructure is there, population growth is there, market trend is there. These all factors always contribute to the commercial property market. But the added advantage which I mentioned is the rent increase, right? If the rent is increased in the property, your valuation is increasing. And if, for example, a new tenant comes in the property, he may spend maybe around hundreds of $1,000s of the new fit outs of the property. So they are spending the money on your property, right? So whenever they are spending, the valuation of your property is getting increased. So these kind of things always triggers or always contribute for the capital growth, right? Rakesh, next. Commercial investment properties. So basically everything has pros and cons, right? We never say like the commercial property always have the advantages, or like it doesn't come with anything like cons. So here I will explain pros: higher yields with the long-term leases. I mentioned already, right? Lower LVR requirements. So basically there is a perception, there is a myth of the investors in the market for commercial properties. You need to infuse maybe 50%, 60% as deposits. But we have purchased properties with even 80% LVR. But 80% is the highest. You cannot borrow even the 81% LVR. So 80% is highest. But again, 80% LVR depends on the few factors like your borrowing capacity and where the property is located, what kind of tenant is there. But long story short, you can borrow up to 80% LVR as well. Set and forget investment. We always say commercial property is set and forget investment, because whatever rental income is being generated by the property, it always pays off the mortgage, right? There will never be any stress on your pocket, like every month you have to infuse some amount in your loan account so that the mortgage is paid off. And even the outgoings are being paid by the tenants, maintenance is being taken care by the tenants, and what else? So because of these factors, I guess we always say that there is a very less hassle for maintaining the commercial property. So that's why we can say it is a set and forget investment. Outgoings paid by the tenants, majority of the outgoings, for example, the council rates, water rates, if the property is in strata, then the body corporate fee, the building insurance, the property management fee, the land tax, it is generally paid by the tenant. But in commercial, there are different types of leases: the gross lease, the net lease, the triple net lease. We can discuss this on case-to-case basis if anyone has any specific query on that. But it depends what kind of lease has been drafted with the tenant, and depending on that, the outgoings are being treated. But we have seen from our experience, in 60 to 70% of the cases, outgoings are being paid by the tenants. Stamp duty fee, free in. So the beauty of the commercial is, you may not know, the stamp duty for commercial properties in few states is discounted. For example, in South Australia, irrespective of the purchase price of the property, in South Australia, there is a nil stamp duty on commercial property, which is a very big bargain. For example, if you are buying a property of 1 million in South Australia, considering the 4.5% of stamp duty, you are straightforward saving 40,000 something, which is, and 40,000 will be from your pocket. You are not getting any mortgage for like on that amount. So it is a big saving. In Canberra, there is a stamp duty saver, maybe up to 1.8 million purchase price, there is a stamp duty waiver. In regional Victoria, there is a 50% stamp duty waiver. We have recently purchased one property in regional Victoria in Morwell. The purchase price was around 2.4 millions, and the investor saved around $50,000 on stamp duty, which is a big amount, which was coming from the investor's pocket, right? And the attractive annual property depreciation, as I mentioned, in the commercial, there is a lot of fit outs, equipment, lot of fit outs and all that stuff. So the depreciation is, you can claim higher depreciation in commercial. And regarding the cons, longer vacancy periods, yes. Once we stop the presentation, okay.
Sorry. I didn't stop it. I was admitting one guy.
You are mute.
Sorry. So I was admitting one person. That's where it happened. All good. Yeah, please continue. Sorry for interruption, everyone.
So there is a cons, like every coin has two phases. So longer vacancy periods. Yes, it is true that the majority of the investors, like they have doubt, they have fear, like the commercial property takes time to get new tenants. It is true. New tenants takes time, but this kind of risk can be mitigated. For example, in every kind of lease, like there is a in the lease there is a clause like after before expiry of the tenancy, and 3 to 6 months in advance, the tenant needs to inform the landlord like what is their plans, right? So if I came to know 6 months in advance my tenant is going, so I have still 6 months to find a new tenant, right? So this kind of risk can be mitigated. But if the tenancy vacates and if you are getting a new tenant, so the new tenant will come with his new plans. For example, they will do the fit outs in the property, they can sign the longer lease, right? You can get a better rental return from that tenant. So sometimes by applying all these, the property valuation can be higher. For example, in one of the case study, one of my property, like our investors property, initially the rent was 16,000, but when the new tenant came, it was a government tenant. They signed the 5-year brand new lease, and they were spending around 450,000 on the fit outs of the property only, right? And the rent was from 16,000 to 25,000, so 9,000 increase in rent. So if you capitalize that around maybe 7%, the property valuation is increased by around 100,000 by changing the tenancy only. Right. So the economic sensitivity, slow transactions, higher perceived risk. So these are the another cons, like which applies to the slow transactions. Means like this commercial properties are not that fast. Like if you want to sell the property, it takes time. It is not like in 2 days time or 5 days time you get a buyer or the seller, like, and then contract is signed. Sometimes it happens. Even we are doing it. Like for example, if the property is listed today, in a week's time we sign the contract and get it done. But it takes time because the buyers are less for the commercial property, the competition is less. So that's the reason we can bargain more as well for these properties. Higher perceived risk, people think that like the risk is high, but as per our experience, it is a good bargain. Like it is a considering the rental returns and all that stuff. So this is good. So I want to show some case studies which we have, like this is these are only few, but if you want to see like what kind of properties we have purchased in the last maybe 3 years time, we have settled maybe more than 80 commercial properties which are available on our website, but we have captured only few here. Like this is the transaction which we done in South Australia. It is a small town, Kingston, SC, South Australia, right? It is a small town. The purchase price was 690,000 and the rental return was 10.14%. It was a dual tenancy. One of the tenant was local pharmacy and the another tenant was ANZ Bank. And the lease was up to 2034 for the next 7 to 8 years time, right? And it was a freehold property. Rental income was combined rental income of both the tenant was around 70,500. So considering the LVR of 70%, which we achieved, and the bank interest rate was 5.85%, but right now it is around maybe 6.4, 6.5%, considering the 3 interest rate rises in the last 3 months time. But this property was purchased before, so here it is 5.85%, and interest only component. This property is generating 41,000 per annum positive cash flow. So the investor who purchased this property, he had few residential properties in his portfolio, and he was bleeding with around 1,500 something like that from one property. So 1,500, if he had 2 properties, 3,000 times 12, 36,000, and this property is generating 41,000. So this one property was offsetting the negative cash flow of 2 his residential properties. Right, so this is the beauty of the commercial. And even this purchase was in the South Australia, so there was nil stamp duty. Stamp duty was nil, so he saved around around $15,000 on this stamp duty. This was the another transaction. It is in Innisfail, Queensland. Innisfail town. It is around 90 kilometers south from the Cairns. It is a big town with a population of around 15,000. So this is again a multi-tenancy, 1 commercial tenant plus 3 residential tenants plus 1 storage shed was there. Right. The asking price was 1.45 million, and we signed the contract at a price of 1.28 million. And the 94,000 was the positive cash flow after paying the interest only payment, considering the mortgage of 65% at 6.29% interest rate, right? As I mentioned, multi-tenancy, and on top of that, like 94,000 is the positive cash flow. But these properties are getting the benefit of the depreciation schedule as well. For example, this property is generating 25K depreciation in 1 year, right? So if the investor is, for example, 40% tax bracket, so this property, another indirect income of maybe around 6,000 per annum. So 94,000 plus 6,000, 100,000 per annum was the passive income from an investment of 1.28 million. So this is the Morwell Victoria. So purchase price was only 275,000. So why we have brought this example in our case studies, because majority of the investors think like for buying the commercial properties, they may need to spend millions of dollars, right? It is not true. We have below 300,000, below 500,000, we have purchased heaps of commercial properties. We all know that, like, with this purchase, like with the price of around 300,000, we are not able to buy a block of land in any of the market, like in Melbourne, in Adelaide, in Brisbane, none of the market, right? But we are buying established properties with established tenants, good leases, good rental incomes. So on a purchase price of 275,000, this property is generating around $10,000 per annum positive cash flow, approx $800 to $900 per month. So you can see, like, if you guys are bleeding with the negative cash flow, so these properties can offset your negative income from this.
And on top of that, sorry to interrupt you, we bought this in SMSF. In SMSF, the interest rates are higher even. If we bought it in a normal, the interest rates will be lower and the positive cash flow will be even more.
Correct. Yeah. So in this case, basically, we have considered the interest rate of 7.29, which is approx 1% higher than the normal interest rate. So still, it is generating $10,000 per annum. Next, Rakesh. So this is today's news. It is mentioned Tuesday, 19th May. The Australian, it was published in the newspaper Australian. So investors eye commercial properties after budget, CGT, and trust hit. So basically, there is a news from this Scott O'Neill. So he is the CEO of Rethink Group. Scott is basically Rethink Group, like it is a big brand in the commercial buyers agency, right? So he was saying they have hired 20 in the last 7 days time once the budget was there, because they are seeing the transition, they are seeing the shift among the buyers who are from the residential to commercial buyers to the commercial property. So they have hired 21 people to meet the new requirements of the investors. And they are saying commercial property specialist and Rethink Group chief executive said he was already seeing money moving out of the residential and into commercial, with many investors attracted to its higher yields. And another thing is the negative gearing is not taken away from the second-hand commercial property, which also didn't get affected by the 2017 budget changes. So they will get to claim second-hand plant and equipment as well. So whatever has happened during the budget for the residential property market regarding the negative gearing, it is not applicable for the commercial property market. If, for example, we always say the commercial property market are the positive gearing because the rental income generated is higher than the interest payments. But if someone has purchased the property, for example, 3%, 4% rental return, for example, in the metro areas or any area, right, and they are negative cash flows, still they can get the negative gearing, right, even after the budget news. So it is a big push, big motivation to enter into this. So I again hand over this to the Rakesh. Basically, what we are trying to show you, like there are few suburbs throughout Australia which we are predicting, like which set to boom in the 2026. So Rakesh, you can explain.
Again, thanks investors for listening to us, and I think it won't take more than 10 minutes now, and then we will take your questions and we'll answer any of your questions related to the concepts we have discussed with you, or any other question if we can answer. So before I discuss about the areas that we have shortlisted with our expertise that gonna be having the growth in the coming 12 to 24 months. So I want to discuss few key metrics which gives us confidence to us or any investor that why those areas growing in the future. It's not like because I think that Horsham gonna grow in next 12 months, or I think Rockhampton will be the next boom area, or anywhere in New South Wales gonna be the next boom area. It's not based on just my emotions or my thinking. It's all based on factors, data factors that contribute to the growth of any particular area. So as you know, in any market, the major factors are supply and demand. So those who are living in Melbourne or having an exposure to Victoria, I can give you an example of Donnybrook, Beveridge, Wallen. These are the areas where there is a lot of supply for the new houses. Even if there is a good demand, still the house prices are not going up. Either they are stagnant or they are even coming down. The reason is not that people don't want to live here in these suburbs. The problem is a lot of supply. So supply and demand is something which is very important. If your supply is less and demand is going up, that area always have the probability to get growth in the coming future. So one of the first factor is RO ratio. RO is renter to owner occupier ratio. So let me give you an example. If any suburb, the owner occupier is less and the renter is more, renter means that particular area or suburb has more investors who have bought the properties. And any news like this, what's happening in the market or something happened in the market, the investors get scared and they put their houses on sale. They try to sell their properties. When a lot of properties comes into the market at the same time, automatically that particular area's prices, house prices goes down. It happens if there are a lot of investors who are active in that market. But if it's balanced with the owner occupier, because owner occupier not going to sell the houses just because the interest rates are going up or there is something news, because they are living there because they have their jobs nearby, their kids are going to the school, they have their family members nearby. So this renter to owner occupier ratio is very important. So if you have renter ratio above 40%, we consider it as a higher risk. So if you see here, there are three colors we have talked about. High means it's very good. Yellow means it's medium. If anything is red, it means it's not good. So for RO ratio, all the suburbs that I'm going to discuss more is comes under the yellow, means they are in a medium ratio, so they are in a good zone. Days on market, again, very good metrics that tells you how many days it's taking for the property to sell in the market. If in any particular suburb it takes 45 days, 50 days to sell a property, it means it takes time for the seller to sell the property. Market is not hot. The market is not very good in that particular area. So anything below 30 days or maybe 35 days is considered as a really good. So the days on market as of now, if you see all the suburbs that we're going to discuss is below 35. So even this suburb, Queensland in Brinsmead in Queensland or Horsley in New South Wales, the days on market is only 15 days, 14 days. On an average, if you put your property on sale today, it's getting sold in 2 weeks or 3 weeks time, which is amazing. Then vacancy rate, as I was talking about, same supply and demand, that how many houses are available for rent. Vacancy rate is how many houses are available for rent. So vacancy rate above 3% is considered as not good. Anything above 3%, we say it's a big no. So if you can see, vacancy rate of Golden Square in Victoria is 0.77%. So there is a high demand for the rent in that market. So as the market for demand for the rent is increasing, automatically more people want to stay in that area. That's why the renting demand is increasing. That's where the houses available are not that much that people want to live there, and automatically the growth is happening. So if you see anything between 1 to 2%, we consider as a medium. Anything below 1% is considered as really good. Now the flood risk. Flood is something, again, a big risk. If there is a flood, if it's a high flood zone, even your insurance doesn't cover the flood risk. So most of the suburbs are very good in terms of flood risk. There is no flood risk in those areas. Bushfire risk, all have 100 out of 100. So none of the suburbs come in the bushfire zone. And then is last one, EDI. It's again very important factor, diversification index. It tells you that particular suburb is how much dependent on a particular type of industry. Like if people are talking about a lot about Western Australia, some parts of Queensland, they are totally dependent on mining. So whenever there is a boom in the mining sector, those areas are the one who grow the higher in the market. And whenever the mining sector is going down, those areas really lose the property value because they are totally dependent on one type of industry. So EDI means the balanced approach, that how many different type of industries are there. If your manufacturing sector going down, is there any other sector in that particular suburb or close by areas that has the capacity to take care and make sure that the property price doesn't go down at the same time. So EDI of above 50 is considered as good. So if you can see all these areas, the economic diversification index is above 50, means these areas are not, these suburbs are not dependent on any one particular industry. Let me going back. So we were talking about Horsham. Horsham is a regional suburb in Victoria. So in this suburb, in this area, there are properties available between 400 to 600K, which is like I'm talking about freehold properties. I'm not talking about any townhouses or units. We have bought a couple of properties in Horsham below 600,000, four bedroom, two bathroom, a good size land, and three bedroom, one bathroom with really good land that you can add a granny flat later, or you can subdivide the land. And you can think in 600,000, below 600,000, you can't get much, and all the factors are in favor of these Horsham that it's gonna grow in the next 12 to 24 months with at least 10% growth. That's predicted from those data points. Then next area is again in Victoria. It's Sale. Again, there are a lot of projects coming in this area from the state government, from the federal government, which gonna be adding a lot of infrastructure, new jobs into that area, and which gonna be booming the housing market. Then in New South Wales, Grafton, very like no one is investing from last 2 years. People are ignoring Grafton, but if you see the fundamentals in that, if you after this webinar, you can open Google on real estate. You can check about this area. You will see how quickly the houses are getting sold. By the time you put your inquiry, the house is under contract. So the other areas are in Victoria. You can talk about Clara. It comes above 600,000 range. If your budget is between 600 to 800, you can talk about Clara. Alfreton, we have bought three houses in Alfreton, and it's one of the really good suburb in Belret. Belret is one of the regional market in Victoria, and Alfreton is the one of the main suburb in Belret. And there is a lot of strong demand from family, very safe area, especially after the COVID. People have started moving to the regional area, and lot of people, lot of migrants who need the for their PR requirements from the immigration, they are moving to these good regional areas where there is a good schools, good transport, safe, everything is available. Golden Scare again in Victoria. So you see a lot of suburbs I'm talking about in Victoria. The reason is all other markets, especially Queensland, Western Australia, they have already grown too much. And if your budget is between 600, 700,000, you won't get much in those states. Either you have to increase your budget, go above 1 million, or you are buying townhouses, you are buying units or apartments, which practically being professional in the market, we don't recommend. We recommend to buy as much possible as a freehold property where you have the control. In the future, you can subdivide, make it multiple townhouses, add granny flat, and lot of uplifting can be done if there is a freehold land and you are owning the land. Then again in New South Wales, it's very good suburb. Still, you can buy something under 800,000. There is a lot of owner occupier in that area, which is actually strong point for any reason. And it's it comes under the Albury Wodonga region. So you must have heard about Albury. It's a very good regional town, Wodonga. So it's part of that region and getting a lot of good growth. Blackview in South Australia, as I mentioned before as well, South Australia is getting a lot and lot of growth. The reason is a lot of, as Vikas mentioned, the commercial, there is no stamp duty, a lot of commercial investors investing in South Australian market. For the first home buyer, there is no capping. You can buy property of $5 million and there is no stamp duty in South Australia. So they are attracting a lot of visas, especially 491 visas, the employer sponsored visas, state sponsored visas. They are giving so much visas that they are attracting a lot of students, migrants, and because of that population growth, there is a heavy growth in the property market is happening in South Australia. So another area is Bransmead in Queensland. So you can do more research. So if your budget is above 800,000, you can go up to 900,000 or maybe 1 million, above 1 million. Then you can consider Horsley. It's in New South Wales. You can consider Windvale. Again, it's a part of South Australia. It's having very strong connectivity to metro, family-friendly suburb with high livability. So these areas are for the investors who have budget above 800,000. Now, as I already discussed this metrics before you, if you have any questions, anyway, we're going to take the questions after this. I think we have discussed most of the parameters, most of the topics that we promised. And now it's time for your questions. And that's the section I love really, because till now I was talking and Vikas was talking and you were listening, and we were prepared with our presentation, what we need to speak, what we're gonna talk. But now is the live question answer session. You can ask anything, and we'll try our best to answer your questions. Please, guys, you can ask any of your questions now.
So, guys, this is a really important time for you guys to ask any of your questions that you've been having. You can either post them in the chat box. We are happy to read it out, or you can just ask, unmute, and ask straight away.
Hi, this is Kushal. I just wanted to quickly ask, I've missed the first part of the session. Would you be able to put a recording at some point of
Yes,
time? Would you be able to share it?
yes. After this, by tomorrow, you will get the recording of the webinar along with this presentation slides in an email. Those who have attended this webinar, you will get the recording with these PowerPoint slides. And you anyway, you have after watching the recording. If you don't understand anything, you still have questions, you can contact me or Vikas anytime, and we can answer any of your question. If you want 30 to 45 minutes Google Meet one-on-one session, we can arrange a session to go in detail, ask your specific question related to your scenario. Today we discuss everything in general, but everyone have their own particular scenario, so we can answer your question based on your scenario.
All right, thank you very much.
Yes, please, guys. Any questions for us? No more questions. So we were that good that everyone understood everything. That's amazing.
There is a question from Varun Bhagat.
Varun,
Varun is asking, measuring risks with commercial in regional or rural areas. The challenge if the lease ends, what are the challenges finding new tenants? That's a really good question, Varun.
I think Vikas, you want to answer or you want me to answer the question?
Yeah, so basically, Varun, thanks for your answer question, first of all. As I mentioned earlier, we always anticipate this question, and we heard a lot of things on this question, like what if, the tenant leaves the property. And me and Rakesh on the other day was discussing, like we live in the northern suburbs of the Melbourne. I'm not talking at the moment, I'm not talking about the regional or the rural areas. I will come to that, but I'm talking about the metro areas at the moment, in the Epping, basically where we are living. So where in the Epping area, there was a retail strip, right? And heaps of major brands was there, right? The Office Works, Chemist Warehouse, Centrelink, Lincraft, Salvos, and heaps of other stores, right? And few months back, majority of the tenants left this space, and everyone, including the local residents, started saying, like this place has lost its value. No one will come to this place now, and the value will diminish now. But only after 6 to 10 months time, the entire area got transformed. The all new set of tenants arrived in that, like the TK Maxx was there, Pillow Talk was there now, Early Settler is there. So whole set of the new tenants arrived, and they have spent already, hundreds of thousands of dollars on that space, right? So like if the new tenants are coming, if they are spending heaps of monies on the properties, so it means like they are doing some sort of the investment into the properties, right? So it is true, like once if a tenant leaves the property, it can take time to get the new tenant. But if a new tenant comes, he comes with his own plans, and it increases the valuation of the property, right? And coming to your question into the regional and rural areas, yes, the tenants takes time, but whatever properties we are buying in the regional or rural areas, it is part of our due diligence process. We always check how much time period the leftover period of, for example, if the leftover period is less than 1 year or 2 years time, we never enter into that property. If there is a multi-tenancy that we can enter, we always see the WALE of the property. WALE is the weighted average lease. For example, if there are 5 tenants, right? So one tenant lease is 3 years, another tenant lease is 6 months. We always calculate the weighted average lease. So if it is more than 2 years, 3 years time, only we enter into that property. Otherwise, we do not enter. Or if the pending lease period is only 6 months or 1 year time, we always check like since how long, for how long the tenant is in the property. For example, if the tenant is in the property from last 20 plus years, so then it is a strong fundamentals, like that tenant will continue to stay into the property, right? So these are the few checks which we always do as part of the due diligence. But yes, if the tenant leaves the property, it can take time, maybe 3 months time, 2 months time, 6 months time. But if the new tenant comes, so you can get the maybe the higher rental return. And moreover, if the tenant, if your property goes vacant after 5 years time, like for example, if you purchase your property today and after 5 years it gets vacant for 3 months time, right? So in those 5 years time, you have already generated so much of positive cash flow, it will not going to impact you for the 3 months time. So you will have the enough capacity to hold that property for the 3 months time.
So,
So
Vikas, I just want to add something here. Varun, again, it's very common question, and we come across this question day in, day out in webinars, in one-on-one sessions. So, how we check being a buyer agent during a due diligence? So, people think that getting a property vacated is easy. If you are running your business, it's a cafe or a retail store, and you have spent 200,000, 300,000 on fit-offs. And we see all these things before finalizing any property, how much money the tenant has invested in that property to run his business. Let's take an example that I'm running a cafe and have spent 200,000 in fit off buying furniture, all this machinery or equipment to run my business. So I don't, I think you won't think that I will leave the property in 2 years, 3 years time and make my money 200,000 going away. So what happens normally is people sell the business. Like you want to get retired, it's your business running, or you have some family challenges. So you sell your business. Someone else gonna buy the business from the point it's running, and whosoever gonna buy the business will honor the lease which is signed already with the previous tenant. So the businesses keep selling. It's very common that today the cafe owner is A and he's getting retired after 2 years. Person B bought the business and he's moving to another state due to his requirements. He sold to person C. But for the property owner, it's not changing anything. He's getting exactly same rent with the same 3 to 4% increases. And whenever a new person is buying the business, he even wants a longer lease. If you are buying a business for 300,000, 400,000, you don't want to buy a business having only 1 year lease pending. And you spend 400,000 to buy the business, and after 1 year, your landlord says, I'm not renewing your lease. What you will do without the lease? You have bought a business. So the motivation of the business buyer is to have the longer lease. So although it looks risky that if the tenant leaves, but practically the probability of tenant leaves if there is a good fit offs and the business is from a long term, that business will close down and that property will get vacant. Again, as explained by Vikas, even if it gets vacated, it's not like the end of the world. It's your property, asset is still there. If you lose the income for 3 to 6 months, if it, as Vikas mentioned, if you get the positive cash flow for 4 years, just if you do the numbers as I mentioned with the residential numbers, if you just do the numbers on pen and paper, how much positive cash flow you have got in that 4 years, if you have to pay the interest for that 3 to 6 months, it will be just a peanut for you. So in real term, it's not that big that it's emotional. It's just thought in your mind or just a fear factor. But in reality, it's not that big.
Thanks,
I,
to answer that. Varun has a follow-up question. He says, process of revaluation. If we have purchased a property at 7 to 8% yield, how do we leverage the yield in the next 12 months? How do banks value the property? And then we have a few other questions.
okay, so yeah, let me answer this. So Varun, again, same like residential properties, there is a capital growth that's there in commercial properties as well. Residential, the refinancing, getting the equity out is bit easier. What I say, why it's easier, because there is no valuation involved. So you simply go to mortgage broker. Mortgage broker orders the valuation with 3 4 banks, and the best valuation that you come from any of the bank, you go with that and refinance and get your equity out from that particular using that particular lender. So because there is no cost involved from your side. But in commercial property, same thing happens, but because the valuation is paid by the purchaser. So if you are the land, if you are the owner of the property, whatsoever is the valuation cost, it can be 2,000, 3,000. It's normally between $2,000 to $4,000 depending upon the location and size of the property. So it is your expense. So that's where sometimes the investors are not that motivated to take the equity out. But otherwise, if your property has appreciated in value and it appreciates automatically because your rental return is going high, or when you bought the property, out of the 3 tenants, there were only 2 tenants in the property, one was vacant. So at that time, the property valuation was 700. You bought it at 700, and in 6 months' time, you found a tenant, and the rental return has increased by 20, 25%, whatsoever is the contribution of that new tenant. So automatically that property's capital price has gone up. And if you do the refinance, you get your equity out. But there is a cost involved, as I mentioned. That's where the investor sometimes is not that motivated. But otherwise, yes, it's similar to your residential properties.
Thanks, Rakesh. Guys, I would like to mention that we are a bit tight on time. We're trying to cover as many questions as possible, but in the interim, I would like to mention that we do offer no obligation discovery calls as well, which will be completely personalized calls as per your needs and advices. So make use, you may make use of those as well. We'll post the link in the chat box. We have another question from Shiril. Shiril says, if you have multiple resi properties, how do you go about equity tap? Is there unlimited borrowing capacity in commercial, or do we sell residential to free borrowing capacity to buy commercial properties?
So, Shiral, very good question. I think because this session was more towards the residential, so we haven't covered that aspect. So the good thing about commercial properties is you don't need any borrowing power, especially the type of properties we are buying. Not for all commercial properties, because for commercial properties, there is a special product from all the big four lenders. That product is known as lease doc. Lease doc means the bank will lend you money based on the lease income of the property. So because we are buying high cash flow properties in which the rental return is above 7%, sometimes even 8 or 9%. So the properties we are buying, they qualify for that particular product. The bank will not ask for any single income document from you, not your personal income, not your business income. They didn't ask how many assets you are holding. Doesn't matter you have 10 properties, 20 properties, you didn't working, your income is zero. As long as you have the cash to buy the property, they can lend you the money. And the only flip side of the lease doc is that the LVR you can get maximum is 70%. It's two options, either 65% or 70. We have, like, if we have bought 100 properties, out of 100, 70% of the mortgages are under lease doc, and out of 70, around 40 of them are 70% LVR, around 30 at 65% LVR. So it's a bit of more cash going from your pocket to secure that property. But yes, the interest rate is similar to your whatsoever you're paying for your residential investment, or if you're going with full doc. Everything is same other than the LVR. So you don't need any serviceability if your cash is ready. As long as you can take the equity out of your residential property, for that you need serviceability 100%, because bank will not allow you to take your equity if you don't have serviceability. But to buy commercial property, you don't need any borrowing power. I hope I have answered your question, Shiral.
Thanks, Rakesh. We have another question from Sagar. He's asking how to find the right value of property compared to selling price.
Sorry,
Not
what's the
too
question?
sure what the question is. Sagar, feel free to unmute and explain your question if you like.
Thanks, Astha, for giving me opportunity. This question is more around like when the asking price or the selling price is, for example, for any property, like how can we making sure like is the right value for money in the terms of the buying point of view?
Okay.
Does that make sense?
Yeah, I got your answer. Sagar, it's very easy in the commercial market as compared to the residential market. So initially, there are different levels. This will be checked first at a professional level. We compare that property's price with the comparable in the market, which per square meter leasing area. Like if the other property have 100 square meter leasing area, our property is 120. So what should be the in that market per square meter leasing rent going on, and per square meter land price. So we compare with that part and see whether the rent is at market or the rent is above market. Sometimes the rent is inflated, and it happens when the seller is selling a property. He's the owner, he's tenant as well, and he tries to put the higher lease to get the more value, more sale price. So after checking the comparables in the market which are sold in the recent 6 to 12 months time, what are the current trends going on in the market, we simply get whether the asking price is as per the market price or they are asking above the market price. So one of the thing that we checked according to this, but as I was answering the question before, there is a paid valuation for all the commercial properties, and the paid valuation is done by a third party valuer. It's have nothing to do with the bank. It has nothing to do with anyone. It's a third party valuer. That's why they are charging anywhere between $2,000 to $4,000 for the valuation. So what they do, they go to the property, they spend 4 to 6 hours clicking every single photo they can click from the property. They compare all the recent sales in the area and they provide with a report of around 100 to 150 pages, depending upon the property size. If it's a small property, it can be 80-90 pages report. If it's a big property, it can be 200 pages report, which is a detailed report about how they come to the valuation of that particular property. They consider it from all the different angles. As I mentioned, we are considering for maybe 6 months time. They have the data of each and every property sold in that area from last 12 months. And then they compare and they've mentioned what is the value of the property if the tenant leaves this. See, what is the value of the property with tenant? What is the property if the tenant leaves the property? It's a vacant property. They put all those things and come to a final value. What should be the value of the property? And if they found that if we sign the contract at 800K and as per their analysis, the property value should be 700,000 or 720, they come up with a valuation of 720, and the bank can't lend you at 800, and that's where subject to finance condition helps us. If the valuation comes shorter, we get another opportunity to negotiate with the seller that see, it's not we are saying it's 720, it's the bank saying, it's the independent valuer saying, and we try to bring down the purchase price to 720. It happened only once with us so far in our 3 years buying history, buying more than 80 commercial properties. But yes, if it happens, it's an opportunity for us to renegotiate.
Thank you, Rakesh. Really appreciate your response. And just further adding to that, so technically, asking price are driven by the yield. Is that right? Yeah.
Not only yield. Yield is one of the factors. As I mentioned to you,
Yeah. Okay.
if it's a very common, we are buying properties where the owner is the tenant himself. He's running a business. He owns the property and he wants to sell the property, but he wants to keep running his business, and he's a lease back. Lease back means he's signing the lease for the property. Because he's signing the lease, he can, if the market rent value of that property may be 50,000, he may sign at 80,000. And by signing 30,000 extra for 3 years, he will get a lot of extra purchase price for that property if we only go with the rental yield. Because 30,000, if you go by 7% for 550,000, the value of the property should be 70,000, 700,000. If it's 80,000, it comes around more than 1.1 million. So he's getting extra 400,000 just by increasing his rent from 50 to 80,000. But it doesn't mean that he can put any value in the lease and say, I want to sell it at that price. So that's where our role comes in. We need to check what he's asking, what type of rent he's offering, whether it's a market rent or he's inflating the rent to get the more value on his property.
Thanks, Rakesh. Really appreciate.
Wonderful. Are there any other questions that anyone else has? Guys, feel free to ask. We have another couple minutes to go.
I have one. I was just wondering, you send across the property information where you have comparisons for 20%, 30%, and 40%. Now, banks lending 80% and we coming up with 20%. Is it very common in commercial, or is it something which you just put it for our information?
See,
Basically, Khusru, like we basically present, 3 different options, like the 20% deposit, 30% deposit, or 35% deposit, right? So to provide you the option or an opportunity to the investor, because every investor has their own circumstances, right? For example, if you have the full borrowing capacity, you want to buy 80% LVR from the bank, right? But if someone doesn't have the borrowing capacity, he may prefer to proceed with the lease doc loan. In the lease doc loan, as Rakesh mentioned, no borrowing is required. Based on the lease of the property only, bank will lend you, right? But in the properties which we are buying, because majority of our purchases, considering the investors' demand, we are buying into the regional areas or into the cities, where the rental return is higher than 8%, 9%. 80% LVR may not be possible, but we always check before putting any offer for any particular property. We always go to our mortgage broker or directly to the bank, like how much LVR it is possible. If bank says it can attract only 70% or 65% LVR, we always inform the buyer before submitting the offer, this property qualify only for this percent LVR, right? So we provide the options, opportunities, like If we put 20% deposit, how much is required from your pocket? If it is 35% deposit, how much from your pocket? To provide you different scenarios, basically.
So on a lease doc, what I understand is on a lease doc, 80% is not possible.
No, on the lease doc, maximum LVR is 65% to 70% LVR. 70% is the max, but we are achieving 65 to 70%. You know, different banks, different LVRs, but this is the range for the lease doc loan.
All right, sounds good. Thank you very much, Vikas. Thanks, Rakesh.
Sure. No.
Thanks all. And that brings us to the end of today's webinar. If you have any other questions specific to your situation, we'd love to discuss those with you in more detail. Please feel free to book a no obligation discovery call with us. I've shared the link in the chat box as well, as mentioned earlier. And we will also be sending out the recording to you at some point today of the webinar, along with the presentation slides for the reference, like Vikas and Rakesh mentioned. So keep an eye out on the inbox. That should be sent out shortly. A huge thanks to Vikas and Rakesh for facilitating such an insightful session today. We truly appreciate your time and expertise. And thank you all for joining today. We look forward to connecting with each one of you and being a part of your property journey moving forward. Thanks all.
Thanks everyone
Thanks a
for
lot,
coming
guys.
here.
Thanks, everyone.
Thanks a lot.
Thank you.
Talk to you soon.
Thank you, everyone.